Okay, welcome to Sacred Account Saturday. It's good to see everyone today. My name is Jerry Fetta. I'm the owner, founder, and CEO of Wealth Dynamics. And every Saturday, I come to you with these courses on the Sacred Account. This is one of the main things that I do. It's the main focus of mine with finances, is helping people become their own bank through the use of life insurance, right? And so we've been doing these courses for the last 4 or 5 years in a row. They used to be on Fridays, and I did every Friday for like 4 years. We switched them to Saturdays in 2022. And in 2023, we're going to be doing some even cooler stuff. But before I dive into this with you today, I want to cover a couple of ground rules, things I cover every week because they're so important. And I want to keep this in mind with you is when a successful person in an area repeats something, it's because it's important enough to say it another time, right? I cannot stress this enough. Like when you hear, like, oh, I've already heard that. I knew this already. We've gone over this. If somebody that's winning at something is repeating a message, you want to ask yourself, why are they saying this a second time? What am I supposed to be getting out of this? I remember when I was 18 years old, I got into financial services. I was being mentored by a guy who really had no business mentoring me. He just saw my potential and was like, hey, I want to spend time with this person. And he was making about $400,000 a year. Okay. When I was 18 years old, that was unfathomable to me. I didn't have any reality that you could actually make that kind of money in any business, let alone financial services, but I knew I wanted to do it, right? So I took the approach of everything this guy says I'm going to do. I'm not going to think about it. I'm not going to question him. I'm not going to go back and forth. And I really was able to think of it like this. If he's winning in this area, what he thinks matters more than what I think. If I'm not winning in the area, to the degree that I'm not winning, my thoughts, realities, and agreements are actually invalid, right? Like I was able to take it to that level at 18 years old. And so one thing that just blew my mind is I thought everyone thought that way. Okay, this is a mistake that I keep making because I think everyone thinks this way. No. Very few people think this way. And so I was on a training call one time, and I remember hearing somebody disagree with this guy. Okay, the person who disagreed was making about $50,000 a year. This other guy was making $400,000 a year. And I remember thinking to myself, why in the hell would you, why would you disagree? Like, just listen to him, copy what he says, do everything the guy says because apparently it works. Right. And I remember when I was 18, one of my first training calls where I was allowed to speak and present, that was what I covered. I was like, hey, I don't know why anyone in their right mind would ever just be like, hey, I want to do my own thing when what everyone is doing is not the thing that's successful. What this guy's teaching is what's successful. Okay. So my point with that is I'm going to cover some information today, but it starts with a few things. And the first one is realizing we don't know it all. Okay, wanting to learn something. Learning comes from necessity, right? So necessity means I have a need, I have a problem I'm trying to solve. And so because of that, I'm willing to look at how do I solve this thing? What's the solution? Okay, so that's the first point. If there's no problem I'm trying to solve, I'm not going to have any reason to think about what I'm learning. I'm not going to have any reason to apply it, right? So I want you to think about that first. What's my purpose for being here? What's my reason? Why am I here? What am I trying to get out of this? What's the problem that I'm trying to solve in my life? And I'm asking those questions and I'm thinking about that. Second thing is that money is not impossible to learn about. It's not too sophisticated. It's not for the wealthy, right? It's for literally anyone that wants to learn. Okay, what I'm going to talk about today is actually specific problems you can solve with the Sacred Account. And so with that being said, and I'm going to just jump into something really quickly on the whiteboard, is when you're looking at finances, we have a couple of things happening. The first one is words. Okay, so we have words. Words are on top of what? Words typically represent math. Okay, so we have words on top, then we have the math of the thing. And so the words, we have a dictionary, we look up the words, we know what they mean. The math, we have a calculator, we use the calculator, we know what problem is being solved, right? So the math, and then we have the concept or the solution. The validity of the concept or the solution is based on the math, right? And then below this, we have the actual problem. What is the underlying problem that we're trying to solve? Okay, a really good example of this. I spoke with a client the other day. We're going to save them about $40,000 on their taxes. Okay, so what's the problem? They're overpaying on their taxes by about $40,000. That's a big ass problem if you ask me, right? 40 grand. That's like almost what the average American family makes in a year. This family is overpaying in taxes. So the problem is $40,000 being overpaid. Okay, the concept or solution. We came up with a couple of different concepts. I'm not going to get into them here because I don't want to get you guys confused with the terminology. But we in a nutshell, we used tax planning. Okay, we use tax planning to say, okay, good. This is the concept or solution. Here's the math behind it. Here's what you're going to put in. Here's the dollars in, and this is what you're going to get on the back end as your return. The math makes sense. And then the words of, okay, what is this thing called, right? So this is, the actual terminology. I'm not sure why I put an S there, but this is the actual title or terminology being used to represent the math. The math represents the concept. The concept is the solution to the problem, right? This is what it comes down to. So when we talk about the sacred account, what is that? This is the term. Okay, the sacred account represents some math. We'll go over the math today as well. The math represents a concept or a solution. The solution represents the problem we're trying to solve. So what it comes down to is two things. Do I understand this? And is my problem actually being solved? Those are the only two things that matter. Do I understand the words, the math, and the concept? And then does it actually solve my problem? Anything else doesn't matter one bit. You're getting lost in the details, right? Too many times with finances, we get this idea that it's complex, it's convoluted, it's confusing. Anytime it feels that way is because it was made to be that way. The problem is not confusing. We all understand the problem. We have too much debt, not enough income, not enough savings. We give our money to Wall Street banks and the IRS, and we sell our assets to live off them in retirement and hope we die before we run out of money. That's the problem. Yeah, the solution is we earn lots of income. We save 40%. We put it in sacred accounts. We invest for passive income. We can become financially independent in the next 10 to 15 years rather than age 60. And we live off that passive income forever and never sell the assets because they produce for us. When we get stuck into, oh, well, what's the fee? And what's this little tiny number over here? And I need to know about, that doesn't matter. You really think that you look at a guy like Jamie Dimon, do you think he understands everything in JP Morgan's business? No. He understands the numbers he needs to understand. He understands the problems he needs to understand. He understands the concepts he needs to understand. And so this is the main thing. What is the problem I'm trying to solve? Okay. Now I know I went off on a tangent there, but it's so important that we start with this. So we want to make sure that we have these mindsets. We can learn. This is something we don't know it all about already. Everything is understandable. It comes down to math, vocabulary, understanding the problem, the concept, the solution. And then the next one is, really being like the mindset of applying. Being of the mindset of applying. When I learn something today, how am I going to use it? Right? Moving into action right away. The difference, the amount of time between when I learn something and when I do it is the number one indicator for me of how successful is somebody going to be. When I tell someone something and I see them take a while to do it, I'm like, good, that person doesn't want it that bad. Right? Like if you were to shadow me for today, you'd be surprised at how quickly I implement things. I hear something that works, boom, on the spot, done, implemented, handled. Right. So I want you to have that mindset going into it today. If something makes sense, don't invalidate it by waiting. If you're trying to solve a problem, why would you continue to wait? Right. If you're injured, why would you wait to get fixed? Why would you wait to get it handled at the hospital? You know that that's going to help you. Go do it. Okay. So these are the things I want to start with. The next thing I want to hit really quick is if you're watching the webinar, Rodrigo Torres on my team is going to be reaching out to you. Okay. So Rod is my top sales guy on the team. And so he's going to be reaching out, helping you with questions and really wanting to connect with you for a call. So what I would like to do is bring Rod on for a minute here and just give him the floor to talk for a second. So let me bring Rod on here real quick.
Hey, Jerry.
Hey, Rod, how are you today?
Good. Thanks for having me on, and welcome to everyone on the seminar. Yeah, just 2 cents. I'm going to put my calendar link here as well if you do want to schedule a meeting. It's a 15-minute call that we do to just go over any questions, anything you need help with on the blueprint. If you haven't already read the blueprint, for anybody who's new on the webinar, I think most of the people on have already read it. Jerry's going to post that where you can get that book for free. But I did want to start by saying it's all revolves around that book. It's all about application. Probably many people here have read a lot of very famous, well-known books that have been published on finance. The 4-Hour Work Week, The Richest Man in Babylon, Rich Dad, Poor Dad. Now, I don't know about anyone else, but that never really left me with a very specific path that I need to take step by step. And the blueprint does leave you with that. And so that's what I love about Wealth Dynamics and the program. And you'll see that too, It's a step-by-step formula that if you follow, by the end of it, you are financially free. And I experienced that myself. In fact, Jerry and I just did a call last week, and he was helping me on my own taxes, and found where I could save an easy $20,000 in taxes. And so we're implementing those strategies, but this applies to anyone. So I just want to encourage everyone to get your hands on that blueprint and study it. Jerry's going to post that here in a minute, I think. And then I'll also put my calendar link so that we could jump on a call, a 15-minute call whenever you have time. Anyways, that's
awesome.
My sense. Thanks, Jerry.
Yep. Thank you so much, Rod. So Rod will be reaching out to you in the chat if you're live on Zoom right now. Throughout the webinar, I might nudge you and let you know, hey, Rod sent you a message. Be sure to touch base with them. One of the big things that we're going to cover today is going to be the sacred account and where you can learn more about that. Obviously, you can do a call with Rod. You can also get a copy of my book here, which we're doing for free. If you go to jerryfetta.com, okay, jerryfetta.com/B2F promo, you can get a free copy of my book. Okay, this is I think the average read time is maybe 5-6 hours, depending on how fast you are at reading. But it's going to give you everything. I wrote this book many years back, in the intention behind it was to give you everything you needed to achieve passive income and financial independence in your life with zero help. Right? Like you can buy the book and then you literally just work your way through it. Okay, here's where I need to start. Here's the next step. Here's the next step. And you can go to whoever and get these things done. Right? So the information is there. Okay, I've been doing this since I was 18 years old. I've helped many, many families become financially independent, get out of debt, and handle business with their finances in a way that gets them done quickly and gets them to the next phase of progress with their finances. The average American doesn't make progress with their finances. Okay, they're either barely making any progress, they're flat, or they're down. Neither of those are good. We want to see that you're making fast progress, you're moving quickly through, and you're able to build financial independence, because at the end of the day, you were not designed to trade time for money for the rest of your life so that you could retire at age 60 and then hopefully die before you run out of money. That's not what life is about, right? That's what they would like you to think life is about, but that's not what life is about. So if you want to get a copy of the book, go to jerryfetta.com/B2F promo. I will be pulling this up periodically. Now, I do have another meeting today, so I'm going to be pretty quick with today's course. Okay, so the sacred account, I want to review with you quickly. Okay, so this is a form of life insurance. It's specially designed. This is not the stuff you're used to hearing about from, the life insurance guy, the people down the road, the State Farm agent, your brother-in-law that just started at New York Life Insurance. This is not the normal stuff you're used to hearing about, right? So this is called high, early, cash value, dividend paying whole life insurance. Okay, and this is a very long name because it's very specific. Okay, so what is it? It's a type of whole life insurance. Whole life insurance means it covers you for your entire life. If you live to age 121 years old, they're going to pay you a death benefit tax-free, even if you haven't died yet. Okay, so it's whole life insurance. Whole life insurance means it's permanent, and there's also a savings component. It earns dividends as well. Dividend is a percentage of profit. So when I own this life insurance, they make me an owner in the company, right? I also get cash value. That's the savings part. A portion of my money goes into insurance. A larger portion of that goes into cash. And so we want high early cash value, meaning we want as much money in cash as possible. We want to minimize insurance costs and expenses. Okay. So here's what happens when I put money into the sacred account. The first thing is I actually get ownership in the insurance company. Okay. And I don't talk about this one enough because I take it for granted, but I get ownership in the insurance company. When I deposit money in a bank, I do not get ownership in the bank. Okay. When I give money to Wall Street, I do not get ownership in Wall Street. I don't get ownership in their firm. I might own mutual funds, but that's not the firm itself. Right. I don't own JP Morgan Chase when I give them money. When I give money to the IRS, I don't own a portion of the IRS, but when I give money to the correct type of life insurance company, I own a multi-billion-dollar organization. I'm a shareholder. That's where these dividends come from. So that's the first thing. I get guaranteed growth. I am guaranteed against loss. I'm protected from creditors. These are all benefits I get with my money in my sacred account. I get protected from lawsuits. I get privacy protection. My money is fully allocated, meaning it's actually there. They're not doing fractional reserve banking. A bank, when you give them money, they're not keeping your money. They're actually loaning that out to other people. They keep $0 of what you deposit with them. Right. And then that's not allocated. It's like if everyone in the world today went to the bank and pulled their money out, the financial system would fail because they don't actually have that money there. Right. So the sacred account, the life insurance companies, they're fully allocated. What they say I have in my cash value is actually there in my cash value. Okay. It's also insured against insolvency. There's a couple that I actually missed here. It's protected from taxation. Okay, I can borrow against my funds. Right, these are all benefits I get. I don't get the stuff with the bank. So here's the long story short on the sacred account. If I put $1 into it, this dollar, I'm going to have about 70 to 90% of it that I can borrow against. Okay, but it's going to keep growing. This entire dollar is going to keep growing at about a 3 to 5% compounding annual growth rate, tax-free. This is the protected from taxation part, right? Tax-free. While this is happening, I can borrow 70 to 90% of that dollar. If I structure this correctly, my cost of interest is going to be about 1 to 3%. Okay, my net effective interest rate, that's the actual cost. The dollars I paid divided by the amount that I have out in loans, I'm going to pay about a 1 to 3% cost on this 70 to 90% of my dollar, but the entire dollar keeps growing at 3 to 5% and experiences all of these benefits and more. Okay, plus I have a death benefit. Like if I pass away, there's so many benefits on this. It's almost hard to cover them all without forgetting about them. Okay, but if I pass away, my family's going to get more money than I actually have. Not the case with the bank, not the case with Wall Street, not the case with the IRS. Right? So I have all these benefits, plus I can double dip my money. And what I want to talk about today is getting lost in the details rather than we need to focus at the bottom up. What's the problem I'm trying to solve? What's the concept or solution? Then what is the math? Then what is it called? Right? Like I almost don't care what it's called. It's called high early cash value dividend paying whole life insurance. We just made up the word sacred account because it's like, that's way too long. Nobody's going to ever say high early cash value dividend paying whole life insurance. We call it the sacred account. So it literally does not matter what it's called. Okay, what's the math? That's secondary to the concept. What's the concept? That's secondary to the problem. Does it actually solve the problem in the first place? If it doesn't, the math doesn't matter. Right? This has to be the mindset with this stuff. So the first thing that I want to solve with the sacred account, and this one might sound unorthodox, is actually income. Okay, this is the first problem that I'm solving with the sacred account. Doesn't matter where I'm at. This is my first reason why I ever signed up for one. I wanted to earn more income. What's the number one way to earn more income? Create demand for it. Who's ever had this experience where your bills go up, you get a new car or you get a mortgage or you have kids and all of a sudden your fixed monthly expenses raise and you're like, shit, I need to keep up with this. And all of a sudden you start getting creative. You start thinking about solutions and how do I make more money and how do I pull in more opportunities? That's called income demand. Okay, in the car sales industry, they use this with their salespeople. If you've ever noticed, the salespeople all drive a car from the dealership that they're either leasing or they're financing because the dealer wants them to have that payment. That payment gives them incentive financially. It gives them, positive incentive. Like I got a reward, I'm driving a nice car, but also negative incentive. If I don't make enough money, I've got a car payment next month that I'm gonna have to deal with. I better go make more sales. Okay, this gets you out of comfortable. So when I do my sacred account, I'm not looking at what's the minimal amount of money I can put in. I'm looking at what's the maximum I can put in without something bad happening. That's the mindset. The difference is, okay, right? Minimal, I'm trying to protect. I don't want to go too far. I'm being very conservative. I want to stay comfortable. I don't want any problems versus the expansion mindset of I can put in 25% of my income. Great, let me do it. I'm going to figure out how to have the money. Right? The second one forces me to create the ideal scene, which is earn more income. Not live below my means, not think about the downside, like actually go make more money. And because of the fact that I've got a fixed monthly automated forced savings plan happening, that's what the sacred account is. My first one I did, $500 or $1,000 a month every month. Boom, I had to make sure that was there. Okay. I did. I would go make more money because of it. And so that's the first thing we're solving is earning more income. Every single one of us on this call need to earn more income. Doesn't matter if you're making $500,000 a year or $50,000 a year. You're not making enough income right now. You need to earn more. That has to be the mindset because there's more to earn. They print it. They literally print it every single day. So why don't we go get more? Okay. So one of the ways to do that without getting lost in the mechanics is give myself a problem, a financially like recurring automated problem that I have to go make the income for. Gets me out of my comfort zone, right? So this is the first part. The second part is becoming my own bank. Okay. I want to save money. Now, for me, like, when I don't know why I'm doing something, it makes it harder for me to do, right? So if I don't know why I'm saving money, I put money in a bank, they don't pay me anything. I literally opened up a new savings account and a new checking account for my business last week with Bank of America. They offered me 0.10%. I think it was actually 0.01%. I think I got the digits wrong. It was 0.01% is what I was being offered. And they're like, ooh, if you put in, more money, we'll bump you up, another 0.5%. It's like, you mean I can, what is that, 0.51? I can earn 0.51% on my money? 0.5%? I'm in, right? Like, no, that's not motivating to me. Why would I put money there? I could spend it. I could spend it and get something I want rather than leaving it in the bank and getting nothing, right? So the banking piece, it's not just what you earn, it's what you save. It's not just what you save, it's where you save it. So if I'm saving it in somewhere that I get all this great protection, it's guaranteed against loss, it's guaranteed to grow, I can't be taxed, it's protecting me from creditors and lawsuits and privacy breaches. I own an insurance company now. Like, those are all really exciting things for me. I make 3 to 5% on my money. I can borrow 70 to 90% of that, use it for investing or paying off debt or whatever it might be, and still have that money growing there while I use it. I want in. That's exciting for me. I want to put the money there, right? So that's me becoming my own bank. Okay, then I can do things. Once I am my own bank, I can solve problems like reserves. I can solve problems like debt. Okay, I can solve problems like large purchases that I'm going to self-finance. Okay, I can solve problems like investing. Okay, all of this gets run through my personal bank. Okay, and this is the important part, because if I don't solve the banking problem, guess what? Banking is going to happen. I'm just not going to get the benefit of it. Try earning an income like a paycheck and not having a bank. Try saving money without a bank. Try transferring money without a bank. It's impossible. The bank's always involved. Not only that, but if you look at the largest banks in the United States, they are number one in 2 important categories. They're the number one purchaser of this exact kind of life insurance, and they're also the number one owner of it. So when we give the bank our money, guess what they're doing? They're taking a portion of that, they're putting it in this exact thing. And they're buying a lot of it. It's not like they're like, oh, we should dabble. No. They're the number one owner. Like I've used this example before. I like pizza. It's one thing to be like, I like pizza versus I'm the number one consumer of pepperoni pizza in the entire country. Right? I like movies. I'm the number one watcher of movies in the entire country. That's a different level. Like, number one is number one. Right? So the very institutions that we're giving our money to that pay us this piddly little 0.01%, they're the number one owner and purchaser of this life insurance. Okay. So I'm going to give you 2 examples today. Like I said, we have to be a little shorter with our call today. The first example, I actually literally just did. So I bought a new mattress. This is kind of cool. Who's ever seen the purple mattress? I finally bought a purple mattress. I was like, I need to try this thing. So I bought a purple mattress. And this is a great example of I'm not going to say a large purchase, but larger than normal. Like, even though I invest and I own several businesses and I bring in all this money and all this stuff, I'm not a big spender. If you've ever spent time with me, I'm not like, yeah, let's go ride Lamborghinis. And no, I'm a normal guy. I don't spend a lot, right? I do a lot of investing. I do a lot of saving. I do a lot of smart financial stuff. I'm not really one to splurge, not because I don't have it. It's just like, that's not my goal. What is this actually going to do for me? For me, being a bodybuilder and being in fitness, sleep is important. Anyone that tells you sleep is not important is nonsense. Your body needs sleep, right? So I want to make sure I'm sleeping well. So I got this mattress. I think all in taxes and everything, it was like $2,800, right? So what I did was I looked at, okay, I could take $2,800 cash and I could put that on this mattress right now. Zero problem doing that. The issue is, what if I invested that $2,800, right? What would that be worth? And we have to think long-term, because this $2,800, like, I'm going to have this potentially for the rest of my life, or I'm not. If I spend it today, it's gone. If I put it in my sacred account, it's going to grow for the rest of my life, right? So I'm 30 now. Let's say I'm going to live till I'm 85, for example. Okay, that's 55 years. And I'm going to make 3 to 5% on average with this money. right? So $2,800 in 55 years grows to $25,177. And 76 cents. This number right here, this is called opportunity cost. Opportunity cost. What could my money have done had I kept it, had I invested it? Anytime you spend, there's always opportunity costs, right? Now, so I look at this and I'm like, okay, good. So at some point in the future, this $2,800 would be worth $25,000. Now it's actually worth more than that, because if I use my sacred account, I can borrow the $2,800 out. It's still going to make that 3 to 5%, which is what I showed you here. But when I pay it back, I can use it again. I can keep borrowing and keep repaying and keep borrowing and keep repaying. And so it's kind of like if every time I borrowed, I was going to get paid, how many times would I want to pay myself back and do that transaction again? Unlimited. I would never want to stop doing that, because every time I do it, I get paid. Right? So when I'm looking at this, I'm looking at, okay, this is what it's going to turn into if I just take the loan out, pay it back, never use it again. What if I take the loan out, pay it back, and use it again and keep doing it? Right? So here's what I did. I like to do it this way. The mattress place, they offer 0% financing. So I was like, great. This is why you need to have good credit. I was like, put it on the 0% financing. And as soon as that bill hits, I'm going to make the first payment from my sacred account and pay the entire thing off. Right now, why would I do that? Because I don't want to use cash. I would rather put the bank's money at risk than mine on this transaction. I don't want to put cash towards the down payment or finance it on my credit card. If they've got 0%, I'm going to say, good, let's do the 0% financing, knowing that I'm going to pay it off in like a month. But now I've got the transaction done. That's the quickest way for the transaction to happen without putting any of my own money at risk. Okay. Now I take a policy loan in about a month for this $2,800. Okay. So I've got, a policy over here. I've got $2,800 that I'm going to borrow out. While I'm borrowing it, this is on average making about 3 to 5%. Okay, I'm going to pull this money out and I'm going to pay off this $2,800 loan that I have with the mattress company. Right? They were charging me 0% interest on the loan. My cost to borrow this $2,800 is about 1 to 3% interest. Okay, so I'm making a positive spread here and I'm paying it off. Now, what was my payment going to be? I think my payment was going to be like $50 a month for the next 4 years. That's what they were going to charge me. So I'm going to do the same thing. I'm going to take the $50 that I was going to pay the bank anyways. You guys have to realize, like, when I do this and people are like, oh, I don't want to borrow my own money and make payments. You were already going to make a payment. I was going to make a payment to the mattress company. $50 a month was what I agreed to. So I'm already going to make that. Why not put it in my own bank instead of theirs? Okay, the alternative, people are like, oh, I'm going to save it. No, you're not. And I'm not even saying you're going to spend it. When you say I'm going to save it, it means you're still going to put it in someone else's bank. You're going to go to Wells Fargo and stick it in their checking account. That's not saving money. That's loaning money for 0.10% interest. That's not saving. Okay, saving would mean that I keep it. It's a store of value. Why would I save in someone else's bank? It's a paradigm shift. We have to stop thinking about, oh, I'm keeping the money. No. When you put it in Bank of America, you're not keeping the money anymore. You gave it to them. You loaned it to them unsecured. They're paying you 0.01%, and they don't even leave it in the vault. They loan it out. They trade it, and that's not there anymore. That's not saving. That never has been saving. That's a myth. That's consumer financial purchasing. That's retail. It's the McDonald's of the financial world. So I have to change the way I think about this. Okay. So when I say I'm saving, that would entail that I'm in control of the money. I have access to it. The value is being stored, right? Just from the get-go, the US dollar is not valuable. Okay. It might represent potential value. I can exchange it for something, but when I keep it, it spoils. It loses 9% a year right now, based on CPI, which means it's probably closer to 18. That's not value. That's not stored. And so I need to get it out of US dollars by putting it into something like the sacred account that is a store of value. Right? The sacred account's been around longer than your bank has, by the way. So that's another thing to look at, right? So I'm making this $50 a month payment back to myself for the next 4 years. I'm paying my policy loan down. I'm paying it off, and I can recycle that money and use it again. Okay. My other options would have been do the $2,800, 0% financing with them, make payments, and lose out on my savings. My $50 a month is now going to their bank instead of mine. right? I would rather keep that 50 or pay cash. I pay cash. I don't get the $50. I get the mattress. That's it. At the end of this, I'm going to have more than $2,800 because that's going to grow the entire time. My savings rate will have gone up because that loan repayment is me increasing my savings rate because I'm paying it back to myself, right? That's saving. And I've got a paid off mattress that I got to use, and it increases my productivity. Okay, if I financed it, I have a paid off mattress and less money saved. That's not good. Right? If I pay cash, I have a paid off mattress and nothing. That's it. Right? So this is the thing to look at. Now, the other one I'm going to share with you really quickly, and this is actually going to be a sample illustration that a friend of mine sent me today. This is from my friend Chris, and he ran this on his daughter, Vivi, right? And so this is an illustration of an actual sacred account, right? This is a life insurance illustration. And I wanted to go over this with you today because, again, it's about the problem solve. You look at this and you're like, okay, well, what does all the numbers mean? I'm going to break this down. So we've got a couple of things happening. We've got the annual premiums going in. We've got the cumulative, right? So they're doing 5K a year. So year one, they put in 5. Year two, they've got a total of 10, 15, 20, 25, so on. Okay. Here's the projected cash value, the net cash value. You're going to see that these are basically the same all the way through. And then, basically what we're looking at is that this will continue growing. And then there's different times we'll take loans out that might lower it, right? But we're looking at what problem is being solved here. So we're putting in 5K a year. And this is from age 1 all the way down. And we're going to continue doing that for the life of this policy, all the way down to age 100. Okay. And even then we're putting in 3K a year for several years, right? We're putting in 5K a year, right? So when we look at this for a 1-year-old, they do this until they're 18. If she's going to go to college, we're solving college already. Okay. So 18 years old, we've put in cumulative premiums of $90,000. The projected cash value is 119 grand. Okay. We're going to take out $20,000 per year for the next 4 years for college, right? So we put a cumulative cash flow, 20,000, 40,000, 60,000. We've withdrawn 80 grand here on this policy. Okay. These are real numbers. We handle college. What would happen maybe next? Okay. Maybe by age 30, his daughter gets married. So that's what's being shown here. We've put in a total of 145,000. Our cash value on this 80 that we took out, it kept growing the whole time, right? So by the time she's 29, we actually have 275, even though we've only put in 145, right? So we've made a profit there, which is pretty big actually. And then we take out another 40 grand out of the policy. At this point, we took out 80 already. We take out another 40. This means we withdrawn 120. Okay, a couple years later, they do a down payment for a house. At this point, we've put in 160. Okay, policy is worth 334. We pull out 60. We've taken out a total of $180,000 so far. Okay, now just again, get out of the details in the math. I want you to just stop and think for a second. What I just told you is that a 32-year-old has $340,000 in their own bank. They've already paid for college. They've already paid for their wedding, and they just bought a house. They have zero consumer debt. Maybe they had the mortgage for the down payment, but they didn't finance the wedding. They didn't finance college tuition. This all came from their own bank. From what? 5 grand a year, $458 or $400, whatever that comes out to. I think it's $423 or $433 a month. And that's easy to come up with. So we're saying for a kid, right? So if you have a daughter, a son, a grandson, a granddaughter, a niece, a nephew, whoever it might be, you could literally set them up for this. Okay, imagine if you did it for yourself. What we just showed you again was 32 years of contributing. Okay, we're not even talking about what if she's taking policy loans to invest in real estate. We're saying literally, what if she just sat on it and just used it for these expenses as they came up? Okay, so this is another example. We go down further. We're still putting in 5 grand a year. We get down to the point here where now the daughter has children. She's 49 years old. She's got kids of her own, right? So she's got a couple of kids. We say, okay, we're going to fund college for them now. So we withdraw another $30,000 a year. That brings our total withdrawals from the policy down to 300 grand. Okay. Up to this point, we've put in what? 260K. It is worth about $1 million, $1,052,000. And we've taken 300 grand out. Plus there's still the death benefit, right? We've got a $3.4 million death benefit, which gets subtracted by the loan taken out. There's a $3.1 million net death benefit that will go to somebody. Okay, again, like think about this, 52 years old, $1 million, not in the stock market. In a life insurance policy that's guaranteed against loss, can never be taxed, guaranteed to grow, gives her ownership in the insurance company, gives her protection from creditors, bankruptcies, all these different things. All of this from one little life insurance policy that we put $5,000 a year into. Okay, now the part I didn't even hit that's amazing, this is similar to a mortgage. When she's up here at the top buying this $5,000 a year of life insurance, that's buying a fixed amount of death benefit, which produces a fixed amount of dividends. So let me riddle you this. In year one, she gives $5,000. Year 49, she's giving $5,000. Is the $5,000 she's giving them in year 49 still worth the same amount of money as it was worth in year one? No, it buys significantly less in the real economy. But because she did this on a contract with a life insurance policy, she's able to use that now. Right? And she's able to get the buying power of it now as if it was still 49 years ago. It's still buying the same units of death benefit. You see what I'm saying? So she's getting the buying power from, half a century ago, even though she's putting that money in today now. Right? We go further into this retirement. Now at retirement, she's put in $320,000, which has grown to about 1.9 million. And she's now going to take out $90,000 a year tax-free in retirement. $90,000 at age 90, total premiums paid $398K. Loans taken was 2.7 million. Cumulative cash value, meaning, including the loans she took out, was 5.57 million. The net after the loans were taken was about 2.93. And then the net cumulative return was 738%. Okay, this is an actual life insurance policy issued on a 1-year-old. Okay, now imagine like the problems being solved here. We can get lost in the math, or we can look at, okay, this is real, it's contractual, right? Like this is an actual policy. What did we do here? We covered her college, we covered her wedding, we covered her down payment on her house, we covered her kids' college, and then we covered retirement with $90,000 a year tax-free. And still had millions of dollars left over. We still had almost $3 million left. Now imagine if we were also self-financing the car and also investing for passive income. Like the list goes on and on and on, and also funding tax planning vehicles to free up even more money to put even more into a policy. Right? Why would I not do this? You have to think about like when you're like, oh, this is too good to be true. Okay, yeah, and also the banks are the #1 owner and purchaser of it. So you really think that they're doing something that's not true? That's not my stat. You can go online and Google that. That's online. You can go find out that the banks actually are the #1 owner and purchaser. There's about 3,000 banks in the US or more that have their money in a policy like this, collectively about $200 billion in cash value. Bank of America, I just opened up an account with them. They have $22 billion plus in cash values from life insurance policies, more than they have in real estate. Think about this. Now, I'm not saying real estate's bad. I'm saying, what if you did this and real estate? I love real estate. I like doing seller financing. I like doing income producing real estate. And I combine my life insurance policy into this. Okay. So guys, I do need to cut this short for today. These are the two examples I wanted to show you. And the main thing here, and again, if you're reaching out to Rod here in the chat, or if you're in the chat, make sure you check your messages for Rod. I just want to give a nudge really quick to a few people before we wrap up. Lawrence, good to see you. Just deep, it looks like Rod sent you a message. Same thing with you, Kip. If you want to check your message for Rod. Michael, it looks like Michael, I know Michael connected with Rod as well. Travis, if you want to check your message as well. Lady Eloise, so if you want to check your messages, Rod can connect up with you too. Okay, Jonathan has a question. Are dividends calculated on the dollar we pay or the 70-90% cash value? It's going to be a blend, Jonathan. So on your cash value, you're going to generally earn the guaranteed interest rate. And then on your base, that's what's producing the income. And that's why we tell you it's 3 to 5% on average, because it's going to be a blended net return, right? So the dividend rate might say 6%. Well, how much of that was coming from my base premium, my whole life insurance death benefit? How much did I have in cash? Every single policy is going to be different. So it's not so much about the dividend, it's more about the compounding annual growth rate. What did I put in? Like on this illustration, 700 something percent. over so many years, and you could put that into a compounding annual growth rate calculator and actually say, okay, good, my compounding annual growth rate was blah, right? And so generally that's going to be that 3 to 5% range, which includes the dividend and the guaranteed interest rate. Reggie, it looks like it looks like Rod reached out to you there as well. So Reggie, if you want to check your chat, Thatcher as well. Let's see, Michael. So Michael, go ahead and sign up with Rod. We will honor the thing you're mentioning if you sign up with him right now. We can't do it after today though. Abraham, good to see you. Abraham said, brilliant illustration, 3 generations in one policy. Yeah, I mean, that's the thing I love about this is generational wealth, right? Like the number one way to secure this is through life insurance. It's been proven over and over and over. The Rockefellers, even to this day, still use this. Reggie says, I spoke to Rod in November, was not ready to open an account at this time. At that time, I'm considering taking the money out of my self-directed account to begin a sacred account. So Reggie, reach out to us on that. We can do a strategy call with you and Rod. Depending on the IRA, I might get involved as well, just to make sure that we are setting things up correctly. Thatcher asks, where and how do we buy these policies? So Thatcher, you have to go through an agent. And so my company can set this up. We're an agent, we're an agency. The insurance companies don't go direct to consumers, so you need to actually work with an agent or you can't get one. So Thatcher, reach out to Rodrigo Torres, let him know you're interested. I would recommend buying the book as well. Elaine says, what if you're already a retirement age 60? So it's still possible, Elaine. You might have a little bit of a higher premium. If you're age 60, we might need to put in a little more than usual. Like a good rule of thumb is at a minimum, you need to put in about 10 times your age for your monthly. So if I'm 30, I wouldn't put in more than $300 or less than $300 a month, right? The maximum I can put in is about 25% of my income, right? So minimum about $300 a month for me, maximum, 25% of income. If you're over age 50, age 60 in that range, generally it's going to be about 15 times your monthly or 15 times your age for your monthly contribution. So for age 60, we would just look at what's 60 times 15. And so that would be a minimum of probably a $900 a month contribution to make a policy work. And then it's just a question of, does the math on that make sense? Sometimes it does, sometimes it doesn't, right? So it is possible. It's not too late. It just does take a little bit more of a contribution to catch things up, which is understandable. Thatcher says, how does the increased death rate due to COVID affect this? There was really no effect by the pandemic. So we haven't seen any change in that whatsoever. Leslie, I've been wanting to advance with the sacred account. Please contact me. I have a few questions. I have spoken with Rod. So Rod, if you can reach out to Leslie and connect with her and answer her questions, that'd be great as well. Travis says, I'm an agent. I want to start offering this type of policy. So Travis, we're actually opening up our business to agents. So we are going to be working with those that want to become licensed or have a license already. We're expanding in the United States and in Canada. So if you're an agent and you'd like to be offering them, you can actually do that through us. We'll handle a lot of the back end work for you. So you can just focus on selling, marketing, and servicing your clients. We do all the rest. And so that's going to be something we definitely can connect with you on. I would say your first move, Travis, is to actually get a policy yourself, right? My number one rule in selling anything is if I don't own it and use it myself, I don't feel good about selling it to others. So I would get your own policy set up with Rod first, and then ask Rod about joining his team and becoming an agent with us. You'll get mentorship from Rod, from myself. And this goes for anyone that's on the webinar. If you want to earn extra income in 2023, we're opening Wealth Dynamics up for you to be able to do that. It can be something you do a few hours a month, a few hours a week. It could be a part-time thing, or it could be a full-time business for you. Okay. So I do need to wrap up. I know I say that a lot and then I keep talking. So this time I actually do need to. I want to share one more time my book. If you have not gotten a copy of it, okay, I want you to go to jerryfetta.com/V2F promo. Okay, and you can get a copy of the book there. Again, it's free shipping, or sorry, not free shipping. It's free. You cover your own shipping. And then you also get a coaching call with Rodrigo. So what I'm going to do is I'm going to open this. I'm going to leave the meeting. I'm going to leave it open with Rod in charge so he can connect with you all for messages, setting up appointments. Again, check out your chat. He'll be able to connect with you for a call and just get any questions you have answered. So I'm going to go ahead and just stop the stream here and exit the meeting. Thank you all for watching. We will be back again next Saturday. Hope you have a great weekend. Again, check your messages, connect with Rod for a call. I would love to see you this week on our lineup of a new client starting a sacred account. Until next Saturday, I'll see you next time.